Good morning, all. Today's topic is about Article 8 of Shipping, Inland Waterways and Air Transport. Foreign shipping company, foreign air transport company. It can be set up in India through a license office or branch office, a joint venture, wholly owned subsidiary. Key operators in shipping business. Mainline operators are those who have independent cargo, separate. They own a separate cargo. They issue bill and leaving to shipper. NVOCC means non-vessel owning common carrier. A non-vessel owning common carrier is they are like an intermediary. They does not own anything. That is a vessel or that's a container, anything. They will act as like an agent between the shipper and the vessel operator. Feeder vessel operator is they serve for the mainline operator. They don't carry the vessel from one port to other. In between, they will carry from the source port to some in between place. Till that they will carry. From there, it will be shifted. That's the feeder vessel operator. Non-vessel own a common carrier. That is, they doesn't own or charter operate any carrying business. They just act as an agent between the shipper and the vessel operator. Tramp ship is the ship which doesn't have any schedule. The price will be negotiated in a tramp ship. That's used mainly for carrying a bulk commodity. Type of charters in shipping business. Bareboat charter. Bar means bar ship is given a hire without any crew or equipment. That's empty ship which will be given. Bareboat charter cum demise. That means charter where ownership is intended to be transferred to the charter after a specified period. That is sales transaction as per AS 19. Leases we will see. After a particular period, the asset will be transferred to the lessor. Like that, the charter ship will be transferred for a specific period. After that, it will be transferred again. Time charter is hire a fully equipped ship along with the crew for a definite period. Voyage charter is hire fully equipped ship along with the crew, but agreement for a particular voyage only. Key operator in our airline business. Scheduled air transport service. Fleet operating according to the published timetable. Each flight is open to use by member of the public. Everything is pre-scheduled. Non-scheduled air transport service. Other than scheduled transport service, it includes chartered flights. There is operations where departure time, departure location, arrival location are negotiated and agreed with the customer. And this tickets is usually sold to individual passengers. Type of charters in airline industry. Dry lease. Dry lease is only aircraft is leased or chartered without insurance, crew, ground staff, supporting equipment, anything. Wet lease is aircraft with operating crew. Full responsibility of the lessor for the operation and maintenance of the aircraft. That everything is with the risk or everything is the lessor itself. The taxability. Taxability of a foreign air transport company and foreign shipping company. For foreign shipping company, two sections are there. Section 192, summary assessment of ship belonging to or chartered by a non-resident. Section 44B is taxation of shipping business of non-resident. Section 44BB is taxation of airline business. Section 192 says that in order to the provision of apply for the purpose of levy and recovery of tax in case of any ship belonging to or chartered by a non-resident which carries passenger, livestock, mails, or goods shipped at a port in India. This section is for a non-resident who hire ship or transport goods, livestock, anything will be taxed. Whereas the ship carries passenger, livestock, mail, or goods shipped at a port in India, the tax rate is 7.5% of the amount paid or payable, which should be paid before the departure from the Indian port. That is, before the departure from any port in India of any such ship, the master file shall be prepared and furnished to the assessing officer. A return of a full amount paid or payable to the owner or charterer any person on his behalf. That is, before its departure from the Indian port, the amount that is the 7.5% of the amount payable paid will be shown as a return to the assessing officer. In some case, the amount is not payable. If the assessing officer is satisfied, he may permit the ship to leave from the port without paying the tax. But the assessing officer permission is required. If he feel satisfactory, he may allow the ship. If the ship departure from the port without paying of tax, the return should be filed within 30 days. That is, the ship which doesn't file the return, they have to file within 30 days of the tax amount. That is 7.5%. 44B is for a taxation of profit and gain of shipping business of non-resident. This is also 7.5% tax of the amount paid or payable. That is the amount paid or payable to the assessee or any person on his behalf on account of carrying of passenger, livestock, goods shipped at any port in India. The amount received or deemed to be received in India by or on behalf of the assessee on account of the carriage of passenger, livestock, mail, or goods shipped at any port outside India. That is section 44B is like a presumptive tax. This also 7.5% tax will be paid. This includes the demurrage charges, handling charges, everything. Demurrage charges is a charge which is levied for not taking the goods from the port within the prescribed time. That is, from the custom, we have to pay the tax and we have to take the goods which we import. If the company doesn't pay the tax and take the goods within the time limit given, they have to pay additional charges for the customs because they are holding our goods in their place. For that, we have to pay. That's demurrage cost. Section 44B is for taxation of profit from operating of this is for aircraft by non-resident. This also same, but in aircraft, 5% of the tax is paid of the amount paid or payable to a non-resident. Purpose. There is a summary of section 172 to make summary assessment of ship or voyage and ensure recovery of tax before the ship leaves Indian territory. That is, they have to pay the tax before departure. There is a circular number 723 dated on 19/9/1995. Which is actually section 194C also deals with work contract. It also including carriage of goods and passengers by any mode of transport other than rail. But it should be 194C is for a agent acting to a resident. 172 is applicable if a agent acting for a non-resident. The payment are made to a shipping agent of non-resident ship owner or charter of carriage The payments are made to a shipping agent of non-resident ship owner or charter for carriage of passenger, etc. Since the agent, if the agent acts on behalf of the non-resident, he steps into the issue of the principal. That is, section 172 is applicable. In that case, 194C will not be applicable. The case law DCIT, this Expeditor International Private Limited. This case law is the agent will be acting behalf of the principal who is a non-resident. In the he is acting behalf of the non-resident. So in that case, the commission is not taxable under 194C. That is, if the contract is, if he is acting with respect to the resident, 194C is applicable. In this case, he is acting towards a non-resident, that is his principal. So he is entering into the shoes of the principal. So section 172 is applicable. This is the difference between section 44B and section 172, because both are taxed at 7.5%. But 44B is applicable in case of regular shipping business. 172 is applicable with it deals with levy and recovery of tax of ship belonging to or chartered by a non-resident. The tax rate in both the cases are 7.5%. Both includes demurrage charges, handling charges, everything. In section 44B, NOC from the port assessing officer for port clearance certificate is mandatory. That is NOC from the AO is mandatory for the port clearance. Profit obtained from operation. Profit directly obtained by by an enterprise from operation that it carries by its own or in the international traffic by ship or aircraft. That is freight from transportation of passenger, livestock, cargo, etc. Profit directly connected with operation. This is activities that are closely connected with shipping and air transport business, such as the incidental transportation of passenger or cargo. Inland haulage charges are charges which is charged for transporting the goods. Lease of fully equipped and crewed ship. Lease of container and short-term storage of container. Detention charges for late return of container. Payment of commission and additional charges to agent. The agent of shipping airline collect freight income of behalf of their non-resident principal. They remit the net amount due to a non-resident principal after deducting their commission and other charges behalf of the non-resident. Airlines have no control over the actual fare which the agent sells ticket. So, as per the agreement, all monies collected by the agent on sale of air ticket will be held by them in a fiduciary capacity. According, there was a contract of agency and not contract of sale. Apex Code held that every action taken by agent is on behalf of the principal and services they provide is with express prior authorization. Therefore, the amount were incidental to the agency contract. Such incidental benefit must come under principal agent relationship. When the contract does not distinguish between various stages of the transaction, ambit of section 194H is for TDS of commission. It's expensive enough to cover indirect payment also. Hence, the contention that payment made by a customer to travel agent is not commission was not accepted. In a principal agent, there could be a situation where principal has no control over how the end objective of the relationship is achieved. That won't change the relationship. Accepted tax neutrality argument followed. Actually, in this case, section 172 will not be applicable. So, you have to direct TDS as per section 194H. They didn't do that. So, Interest as per section 201 1A will be levied. Tax benefit to shipping company and airline company set up in international financial service. Income by way of royalty or interest on account of lease of ship paid to a foreign entity is fully exempt from tax in India. No capital gain tax on transfer of ship by a IFSC unit, which enjoys a 100% tax exemption. The above two exemption are subject to IFSC unit commencing its operation by 31st March 2024. For airline in IFSC, 100% tax exemption to units set up in IFSC for any 10 consecutive years out of total 15 years. Depreciation on aircraft and air engine shall be allowed at 40% on WDV basis, written down basis. Unobserved depreciation can be carried forward without any time limit and can be set off against future profit. There is no time limit for setting off the unobserved depreciation. Income by a royalty or interest on lease of aircraft paid to a foreign entity exempt from tax in India, subject to that unit commencing its operation by 31st March 2024. Exemption from capital gain tax on transfer of aircraft, air engine by an IFS unit, which enjoys 100% tax exemption. They should also commence this operation by 31st March 2024.
This is commencing operation by 31st March means
before
31st March. That means before any of the year, or is there any condition for when it is starting?
Actually, from April 2022 it started this circular scheme.
Okay.
The current year or the next year they have to start their business, so they can claim that 100%. India-Malaysia Tax Treaty. Article 8 of India-Malaysia says that profit derived by enterprise of a contracting state from an operation by that enterprise of ship or aircraft in international traffic shall be taxable only in that state, that is in the source state. For the purpose of this article, profit from operation of ship or aircraft in international traffic shall mean profit derived by an enterprise described in para 1 from the transportation by sea or air respectively of passengers, mail, livestock or goods carried on by the owners or lessees of charters of ship or aircraft, including the sale of ticket for such transportation on behalf of other enterprises and the rental of ship or aircraft incidental to any activity directly connected with such transportation. Income from incidental sale of ticket on behalf of the enterprise, rental of containers of enterprise engaged in operation. Thus, in operation of ships, this sale of ticket, rental of containers is also covered. This is India-Malaysia Tax Treaty. In India-Ireland Tax Treaty also, Article 8 says about the same. That is, in what are in the Malaysia Tax Treaty, the same is in the India-Ireland Tax Treaty also. Profit derived by an enterprise of a contracting state from an operation, rental of ships, aircraft, international traffic, and the rental of containers and related equipment which is incidental to the operation of ship, aircraft in international traffic shall be taxable in, but here it will be taxable only in the contracting state. There it will be taxable in the source state. That is in that only in that state means that is the source state. Here the contract statements in where they are the contract. India-UK Tax Treaty. Article 9 speaks about the shipping. Here, the income of an enterprise of a contracting state from the operation of ships in international traffic shall be taxable only in that state. The provisions of paragraph 1 of this article shall not apply to income from journeys between places which are situated in a contracting state. In India-UK Tax Treaty, the operation of ship, the term is not defined. India-Singapore Tax Treaty. Article 8 of India Singapore Tax Treaty. Profit derived by an enterprise of a contracting state from the operation of ships or aircraft is international traffic shall be taxable only in that state. Article 24 speaks about where this agreement provide with or without other conditions that income from sources in a contracting state shall be exempt from tax or taxed at a reduced rate in the contracting state. And under the other law enforced in the contracting state, the state income is subject to tax by the reference to the amount therefore which is remitted or received in the contracting state. That is, the amount remitted or received in the contracting state is taxable as per Article 24. Procedure for port clearance procedure. Step 1, they have to obtain DIT exemption. That is, DIT exemption is like in TDS we get a section 197 lower deduction certificate. In this case, DIT exemption is nil rate. They don't need to deduct tax. That is, previously I said no, 7.5% tax has to be paid. If DIT certificate is obtained, they need not pay the tax. Step 1 is to obtain DIT exemption certificate wherever foreign shipping companies entitled to DTWA benefit along with annual NOC containing name of the vessel for which relief is granted from the jurisdictional AO. Step 2 is where annual NOC is not available or does not contain the name of the vessel, file undertaking with the AO at the concerned port before arrival of the ship at the port and obtain voyage-wise NOC. If we don't annual NOC is not available or they does not the vessel name is not available, they have to, before the arrival of ship, they have to obtain voyage-wise NOC. Step 3 is obtain port clearance certificate from the custom authority on the basis of annual NOC or voyage-wise NOC. Step 4 is ship is allowed to leave India on the basis of port clearance certificate from custom authority. Step 5 is the file voyage return under section 172(3) within 30 days of the departure of the ship along with the challan of the tax paid or file DIT certificate. That is, the taxes paid. If the taxes are paid, they have to file a return under section 172 within 30 days. If they are obtained the DIT relief, they have to submit the certificate if no tax is payable. Time limit for passing voyage assessment order under section 172(4)(a) is within 9 months from the end of the financial year. They have to pass an voyage assessment order. Step 7 is option under 172(7) to be taxed under other provision of the act. Option to be exercised before end of the assessment year.